Hi everyone, welcome to the 16th episode of Learn, Invest, Grow Show. Tay and Adam are here. Today we have a special guest, Anthony Scandariato. He's a co-founder and managing principal of Red Knight Properties. Red Knight Properties is a real estate investment and property management company with a focus on value add, multifamily, and mixed-use properties. Hey Anthony, thank you for your time today. We are really excited to have you on our show.
Hey, Adam, thank you so much.
Yeah, thank
Yeah,
you. I remember, we know each other for about 4 or 5 years. We run into each other at a lot of these real estate meetups, and you really are an inspiration because a lot of people talk about how they want to do what you're doing. You're doing it, which is amazing. I mean, you're not just an ordinary person. I mean, you went to you went to Columbia, right?
Cornell.
Oh, sorry, Cornell. You went to an Ivy League school. You're analyst for Vision Properties. Your your focus is office, which is a lot more. It's not as simple as multifamily, you know. So you're
Especially
definitely
right now.
yeah. Well, yeah. And now you've how many deals have you closed already pre-COVID, and now like
Um, well, I was at Vision. We probably closed while I was there, maybe say 7 or 8. But these are larger deals, more institutional.
yeah.
Um,
But now for the multifamily, because you were closing deals. I mean, did you close some deals when you were working there, so you could leave your the Vision Properties?
yes. So I closed a couple of smaller properties later, right before I knew I was going to make the transition. It was, I think, how many we closed? We closed maybe 7 or 8 properties, which totaled about 70 units of apartment units and mixed use. But that was um, in the month of mostly September, October of
Okay,
2019.
okay,
Um, and then I closed on a larger, well, at least for me, a larger deal that we ended up syndicating in December. And then I had another one under contract. I got under contract in December as well, which I would close obviously that subsequent year, which was this year, 2020. So that's kind of how that process started. So yes, there were a few deals, but um, they weren't really in confluence. They were more of deals that we were closing. I did do a few, I think maybe 4 of which were late 2018, but pretty, um, they were pretty stabilized, but there was still a lot of value add to them, and we were able to do some nice case studies in terms of cash out refinances on those. So yeah, so this has actually been going on for me since 2016. So it's been 4 years, but definitely on the smaller scale, not what we're doing now, at least.
that was with your partner, the who played Brian. He used to play in the NFL, which is you have to name the Scarlet Knights because he was what was it? He was a he won something at Rutgers. I'm drawing a blank on what he got there. Uh,
Oh, I think there was some trophy award that he won
yeah,
at Rutgers. He played there throughout his whole college career, and then he played 8 years in the NFL. As a fullback for 3 different teams. Great guy. He's still my partner today, and
you
all
yeah.
those
met him.
properties.
And when did you meet him? It was
I met him in late 2017,
got it. Okay. So
and
when you first started, most of your deals were just with you and Brian. You didn't really have any other. You weren't really syndicating with other investors.
correct. So the way that my progression worked, and some people have very similar progressions, is on my own. I bought my first 2-family in 2016, just by
Mm.
myself, and then a couple months after that, I bought another 2-family with myself and another partner, which happened to be my father, a family member.
Nice.
And then when I met Brian, we got to know each other for a few months. We were looking at deals together. There was that window of, obviously, it's very important to figure out, who you want to get into business with because they're going to be your partner. And real estate, it's not a get rich quick industry.
Right.
So you might be holding properties for 10 years, maybe even longer
It's a marriage.
sometimes. So
It's a marriage, basically.
it is. So we got to know each other for basically a year before. It's almost like dating.
Yeah, you
So
had your little honeymoon, stage, dating stage till yeah.
exactly. So we were looking at deals together, and then we closed on our first one. That was September of 2018, and then we were able to refinance out of that. Not out of it, we still own it, but in September of 2019. So that was our first larger case study that we had under our belt on our own, and that's when we started to, looking at pooling capital together to do the syndicated deals moving forward.
It's great. And that's really amazing. So basically, what happened was you started syndicating, you locked up and closed a few deals. You're able to generate enough cash flow to supplement your W-2 job income.
Yeah, well, and the goal was most of that, like I mentioned, most of those properties were at the tail end of my W-2 job, so I didn't see the reaps of the income really until I left. So obviously in 2020. That made me feel much more comfortable in order to take the leap. So that's how that whole transition worked.
That's great. And now, in terms of what's how things were working out before pre-COVID, how are you making adjustments now? Because really, you want to start preparing for 2021. I mean, first of all, did you close anything this year, before year end?
Yeah, we closed on, I believe it was four transactions this year we've closed on. If I have to count, yeah, 4 transactions, 3 of which were syndicated deals. One of them was just another personal smaller deal. So yeah, we closed on a lot this year. And moving forward, we already have some projects lined up for first quarter of 2021. And we did a refinance this year too. So when people think about deals, it's like, okay, did you buy anything? There's other components too to deals. So
100%.
Yeah, so we were able to refinance out of another deal in May, actually, right after this was all. Yeah, mixed use property.
Let's talk about that, because that's interesting. I mean, COVID hit. I remember we spoke about, I think it was around March we spoke, and you had a deal under contract. Lenders were pulling out left and right. Like, how'd you manage to close deals, and what kind of adjustments did you have to make during this, COVID shutdown that we experienced?
Yeah. So it was good that I wasn't alone, because everybody else was feeling the same pain at that time. So, and we're still feeling pain. We are, we're in New Jersey. We're still feeling pain over here. So, when that happened, we just had to adjust and adapt, and really no one knew what was going on. So it was really, as both of you well know, it was a month of kind of what's going on, maybe even more than a month and a half. So we, in that specific example, we really had to negotiate extensions, and literally, I got the seller's phone number, and we had to just convince the seller to just let us extend. So that's how we were able to mitigate that. We took a lot of risk there, like, especially when you're dealing with a difficult seller, but at least it paid off. So we actually were supposed to close that in April. We didn't close it until July. So it was a 3-month delay. So we still got it done though. And it was very challenging.
Was there any retrading at all, or?
No retrading on price. It was just extensions, more hard money. It was very stressful. But we got it done. And what we ended up having to do was just switch the type of loan that we were going for. As you well know, if the lender doesn't have their own balance sheet, a lot of the bridge lenders don't. They usually use a warehouse line. All the warehouse lines are funded by some hedge funds, and hedge funds shut down. They stopped funding those lines. So that's what happened. And then we had to switch to agency product, which obviously is, backed by Fannie and Freddie, which is government backed. So they were the only ones. And, they're still big in the game for lending on multifamily real estate and have an initiative for, getting into 2021 outlook to lend. I think it was at least 30 to 40% of their loan portfolio, at least their mandate for 21, into affordable housing.
Affordable housing. Yeah.
So, because there is a crisis in this country,
Right.
where you can't keep up with the demand of affordable units. So that's what we specialize in, the kind of workforce housing. I would say it's more class. I wouldn't say it's class B. I'd say it's class B minus, C plus ish, but it's not C.
Yeah.
So, and obviously we work to implement value add across the portfolio and make the communities better. So from a lending perspective, they have initiatives. They get tax credits too, to lend in some moderate, to lower income areas as well. So even, we did some deals with some local banks this year. In terms of adjustments, it's just really understanding everything had to adjust. So, from underwriting to financing, pretty much everything, to timeframes on construction. Pulling permits takes longer. But I would say you always have to be prepared for something like this, because it all comes down to, if you're doing, acquiring properties, it comes down to the buy. And if you're not factoring in at some point, what happens if my exit cap blows up 300 basis points from where I bought it at? What happens? Am I still making, a stock market average return over the 10-year life? If you're not looking at those things, you can be in big trouble, especially right now. So we always we knew something was coming, and that's why we really wanted to focus on the workforce housing, because we saw it was, such an issue in this country.
So you knew this pre-COVID. It just happened really fast, unexpectedly. This type of event.
Well, it was the health crisis was unexpected, but the financial crisis everybody was kind of talking about it for 2020. So it kind of all came at once. So
yeah. No, I share the same. Tay and I share the same belief that not just us, but I mean, there's a shortage. You look at that. There's a shortage of workforce housing. Not enough. So, and that's interesting. Now, I guess in terms of underwriting, let's say a typical multifamily deal, are you seeing discounts on these post-COVID acquisitions? And then how are you factoring in like different, the eviction moratorium, different things what do you have to watch out for? Like, what are you doing basically?
Yeah, that's something to definitely keep your eye on, the eviction moratoriums. We are and as you know, real estate's very local. So, we're buying, our portfolio is in New Jersey, Pennsylvania, New York State, small building there. And then we're actually should be closing in the next couple of weeks on a deal in Florida. So
Florida, wow. Where?
Yeah, and there's a reason for that.
Tampa, right?
So there's
Yeah.
so there's 4 states. So for us, we want to be diversified geographically as well, because like you just said, there's various different landlord-tenant laws, and Florida is a good example of a state where you can evict people right now. So it's a lot different than New Jersey. New Jersey is the only state where you really can't, and obviously New York, California, you really can't. They're not even having hearings for non-payment of rent. So when we're evaluating new projects, to be honest with you, we're not even really looking much at New Jersey right now, because we don't want to, expose ourselves to that risk moving forward. So it really depends on the market. So we're very cognizant and in tune with all the eviction laws. Pennsylvania too. Outside of Philadelphia, they're doing evictions. So that's, we own in Lehigh County, Pennsylvania, New York State, they're still holding off. So I would just, there's a good site, Landlordology, which kind of explains all the landlord tenant laws per state. So I would encourage your listeners to take a look at that, and then always get a good landlord tenant attorney. We have one that works in, multiple states, and they have webinars on, the eviction laws. They actually had one last week, and,
Really?
and they're not even expecting New Jersey until April. So we'll see.
Wow.
And I already knew that, but yeah, it's just something to be aware of, when you're underwriting moving forward. Some states will be more friendly to you than others.
Well, it's interesting. So now, in terms of going back to discounts, are you seeing any discounts? Because I'm reading that on the larger multifamily, there really wasn't a lot of discounts, maybe for the smaller stuff. But what are you seeing on your end?
Yeah. So I seeing, and sorry I didn't answer that question before, but I'm seeing kind of no discounts really on much. Even the smaller deals, they're still at least a little more aggressively priced, at least for my liking. I think it's because rates, as you know, are very low, especially, if agency lenders, the Fannie and Freddie lenders, are one of the bigger games in town now. I mean, they're lending at 2.5%, 3%. Obviously, what does that do to cap rates? It compresses them even more and more. I don't think rates are going to go up anytime soon. I can even, almost say within the next 10 years, they're not going to go back. Within the next 10 years, they'll probably go back to where we were before, 4.5%, 5%, fixed. But, it all ties to, inflationary metrics, economic metrics. So who knows? But rates, at least as of now, are low, which is in theory driving up the real estate prices. Is that going to last forever? No. So as you know, it's a cyclical business. So you just have to know when to get in and get out.
That makes a lot of sense. And that's interesting. And in terms of like when you're evaluating a potential acquisition, right? Let's say it's a value add. What are you doing now? Like, how are you underwriting, let's say, the rolling of your tenants? Like how, when the leases burn off, like how are you underwriting this? And because typically pre-COVID, how would you underwrite it compared to now?
Yeah, to be honest with you, it's not super different. I'm a little bit different than a lot of other operators who, we're buying stabilized workforce housing, garden style, 2 to 3 story, apartment communities. And pre-COVID, we're kind of looking at in-place cash flow, like the whole year. Like we're assuming we don't do anything for an entire year typically, but then year 2, year 3, obviously we get the value add rental increases. Now that might hurt us when we're trying to acquire property because we're not as aggressive on the underwriting as a lot of other operators are, and I've seen it. I think we're pretty conservative, and I'm not just saying that because I should be saying that. But we've always kind of been that way. It's like if the deal doesn't work going in, then we're not going to buy it. So I don't think it's changed from that perspective. I think from, Adam, like you mentioned, maybe the rolling of the tenants, taking a little bit longer to get to the rental increases, a longer period for your CapEx plan, maybe, even showing a little bit of a longer holding period, taking on longer term debt just in case anything happens. We're trying not to do bridge loans right now. Like I said, from the financing perspective, we don't want to get caught in any traps again. So a lot of things changed. Obviously, lender reserves, they're still doing the COVID reserves. I don't think that's going away anytime soon. Typically is the year of P&I up front. So it makes it more challenging for operators to do, larger transactions.
For us, for the fix-it loans, we did have that, but that went away.
That's great.
Yeah, which, I mean, it's like a V shape with the private lending space. It's, the credit boxes are opening wide open again. So I would think the same thing will happen for workforce, multifamily, workforce. Luxury is a different animal, but I would think that it's going to be. I think it's going to improve. That's what I think. So now,
Anthony,
yeah,
okay.
go on.
I'm just like a personally curious about some of the metrics in your portfolio. So can you share some like trends in something like a vacancy rates and rent growth, or any like rent collection rates in the light of the pandemic? Yeah.
Yeah, since March, our collections have been like 94%, 95%. Our occupancy has been like 98%. So, you're looking at like 93% collections since March, I would say. It's gotten, believe it or not, it's kind of stayed the same. You're always going to have bad apples that are tenants, unfortunately. You try to mitigate it as best as you can, of course. But you're always going to have maybe one or two. So unfortunately, we still are stuck with them on at least one project that I know of. But the collections have been really good, and that was something that we were pretty cognizant of, throughout the whole process. I think in terms of what has changed, we're more, because we, in some states we can't really, in New Jersey, for example, you can't evict anybody for non-payment. We've been, at least with a few of the tenants that are really struggling, we're working out payment plans. We did still file, so when the courts open up, of course, we're going to get heard. But we're working out payment plans, working out, creative solutions, and giving back security to using security deposits, but then signing them up for a security deposit bond, which lasts a few months. So yeah, we're getting a little creative, but it's not like it's like 20%, 30% of the portfolio, because if that were the case, we'd start looking at defaulting. So it's not even close to that. But you're always going to have tenants who are struggling, and even if we could evict them, we usually still try to work with them for, at least a month, and then we'll go and file.
Yeah, you don't want to be the bad landlord that just doesn't have any type of empathy for a family with children, and it's a really weird time we're in. Hey, I know you got a whole list of questions that you want to get out.
No, I mean, I'm just like curious, like, how do you feel about the potential stimulus package?
Oh, yeah,
I mean, do you think it'll help real estate to a significant degree down the road? Or?
Yeah. So we're talking about stimulus. We're recording this. I think the Senate passed it. I think the president has to sign off on it if he does. So I know in that package there was, I think it was $20 billion for rental assistance. As you guys are aware, the federal eviction moratoriums are until the end of the year, this year, 2020. In exchange for the rental assistance, they moved it another month. So that's the end of January 2021. So in theory, you're still kicking the can down the road a little bit. But I haven't seen, to be honest with you, what that rental assistance looks like yet. I know last time it was at the state level. So we sent out a message. We didn't send out a message to all our tenants, but just a few that were struggling, to apply, and quite a few got it. So, it's, I guess, temporarily a good thing. But, there is a lot of long-term repercussions to keep just printing money, in my opinion, but that's a whole different discussion.
Oh yeah. I mean, that's interesting though. I mean, we'll see how this progresses. Obviously there's going to be, this is just a stimulus, just a little Band-Aid to get something out. But obviously this is going to be an ongoing thing. This is not going to come to an end shortly.
Yeah. And again, we're buying in the workforce housing segment. So we're looking at an average rent of maybe $1,000 across our portfolio, give or take. So if we're acquiring properties, and, for example, like New Jersey, I think they're one of the highest state unemployment benefits they pay. Was it $600 a week or something like that?
Yeah.
Even if they got laid off, and, tenants did get laid off in our portfolio, they still paid. They still got the unemployment. Well, at least, trying to get it. But those who got it, they did pay. with that, and then they were able to get back up on their feet. Now, again, there's a whole economic problem with that, but at least temporarily, and then hopefully into 2021, probably second quarter of 2021 is probably going to be really, really good. If I had to guess, I don't know yet, but it has benefited. But again, I'm not a huge fan of kicking things down the road, because that's an effect of what this is doing.
Yeah, no, you're right about that. What else? I know Tay's got something else.
So I think that the workforce housing is definitely the high demand, and so you're in the really right place. And do you see also like a noticeable migration from urban environments to suburb because of a pandemic? And then that's how you also focus more on the suburb area
Yeah,
compared to in the past. Yeah.
yeah, and I forgot to mention that we're not really buying in CBDs, large. We're still buying in within metro areas, an hour and a half within a metro area, but it's mostly suburban. Some infill properties, which we're buying in a town that has a downtown. Maybe we're buying in the downtown, but it's still not New York City, still not Boston, still. So yes, there has been migration for sure. And when we have vacancies come up, I mean, they get filled within a week, maybe, across the portfolio, at least in New Jersey, Pennsylvania, New York State. Whereas before, maybe an average of 2.5 weeks. So it's definitely helped with leasing quicker once we have a vacancy and the unit looks good. So who knows if that'll last forever? It'll probably reverse back slowly at some point. I don't know about New York. We'll see what happens. But it has definitely had a benefit and migration for us, but not like huge. Mostly, like I said, mostly it's quicker turnover.
Quick overturn, yeah, because now you have more demand because of people leaving in droves, New York, and
more of a renter pool. Yeah,
that's a perfect combination in your favor.
Sure.
And the places that you buy at are by train stations, right? Like
somewhat, yeah. So we still look to buy in areas that have infrastructure, that have an economy, a local economy that has a decent amount of jobs. And yes, to be honest with you, I don't think maybe one or two of our tenants commutes to New York City for work. I don't really know. I think they work within the localized economy for the most part.
Yeah.
But if they had to, there's still access to major highways, transit. Usually we buy within a walkable downtown, like 5 minutes from a downtown, give or take. So there's always an economy where we're looking to buy, even if it feels like it might be in the sticks. So it's really not.
Yeah, no, that makes a lot of sense. Now, okay, so now we're coming to an end, very shortly. But just give us why multifamily for 2021. COVID was a very, very tough year. But what do you like the outlook? Like, why workforce housing? Why multifamily? Let's hear from the expert.
Yeah, I mean, by means, I'm not an expert. I'm still learning every single day.
Yeah.
But from what I'm seeing and all the reports I'm reading, and I just talked to another gentleman yesterday about mobile home parks, and we were both basically saying that, I think in order to keep up with demand, I think right now there's a shortage already. I think it was like 40 million units that are short, and because you have a lot of people who can move, that are adults that are still with their parents, or they have a larger family and they're all living together because they simply can't find an affordable apartment. So, and to be honest with you, a lot of that housing stock is in the Northeast, the West Coast, a little bit in the Southeast, where there's a large barrier to entry in terms of new development for workforce housing. That's why you're seeing a lot of light tech deals, low income housing tax credits. You're seeing more of that initiative. So like I said, there's a shortage in order to keep up with demand. I think it was in order to keep up with demand, you need to build I think it was 3 million new units a year just based on population growth and migration. I mean, who knows what's going to happen moving forward with the immigration system in the country. So you got to look at that too. There's so many different aspects, and it's kind of hard to say. I mean, I think a lot of people made predictions that were wrong for 2020. I think probably 80% of them made bad predictions. So I don't want to be in the predictions game. And they're probably going to be wrong for 2021 too. But again, we're just trying to look at the market research the best we can, and kind of take it with a grain of salt and plan from there.
Yeah, it makes a lot of sense. You just want to follow, just follow what data is telling you. There's a shortage of workforce housing, and if anything, we're becoming more. We spoke about this prior, but this is becoming a renter nation. There's going to be, there's a huge affordability gap for people to buy a house, because wages are not keeping up with, the appreciation of these houses. If anything, lower interest rates is pushing up the pricing of houses, and rent growth is, the wage growth is not even keeping up with the rent growth, right?
Exactly, and it's a whole combination. And like Tay mentioned, if you have people in higher income areas like New York City that are making a decent salary, but they don't need to be in New York anymore. They're still working for the same company. They may move out, 45 minutes to an hour, and their rent is like not even a fourth of what they were paying in New York. So you have that problem too. They're able to pay, the suburban rent increases that maybe you had, a $900 unit and now it's worth $1,300. Maybe you wouldn't have seen that unless you get more higher income people moving in. And like Adam said, it's more of a renter nation. I forget, maybe you posted a report about that, Adam, that I was reading. That was pretty interesting. More people aren't going to be able to afford buying homes just because of the affordability. There's probably going to, usually there's always, when that happens, the government gets involved and they try to make it more affordable. But again, there's always going to be a need. It's at the end of the day, it's housing. People always need a roof under their head. So it's not going away anytime soon.
Yeah, and I agree with you 100%. That's why we're investing in this space. It's easy. It's probably one of the easier assets to study and underwrite. There's so many different assets. There's hospitality, retail. There's a lot more moving parts, and but residential. This is something that people always need to live somewhere. And I love the fact that same thing with us. We like workforce housing because we know that if anything, there's going to be more of a demand in the future. We're looking at now. Yes, when you're buying potential opportunities, you're going to look at the short-term distress that we may or pain that we're going through in terms of dealing with the eviction moratorium. But you're going to factor that into your underwriting. But long term, you should have a quicker lease up. And you should have a huge tenant pool to choose from versus like, let's say Class A apartments or,
Yeah, the A apartments have been hit for sure on their rents. So a lot of them have tax credits, especially if they're newer developments. So they're still able to, if they have debt, still service the debt. But they really got hit in terms of valuations. $3,000 one-bedroom apartment and close to Manhattan, Hoboken is not the same anymore. If you look at Manhattan, I think it's 25% vacant now.
Something
and
like
I just was talking to a friend. I think he's the Upper West Side, and he went to go renew his lease. I think he paid $3,500 a month, and now he got a year free for 2021 because he threatened them. He said he was going to move, and I think he's only paying like $2,200 now. That's a huge drop, huge. Plus your concessions. So if you look at your net effective rent,
Wow.
Yeah, look, I think New York is not going anywhere. I think there's going to be a huge. This is what I'm thinking right now. I think there's going to be a huge change in ownership. The ones that are going through the pain, then someone else is going to buy at a discount. And that's what's just going to happen. I think it's always going to be, people are going to want to live there. It's just, right now, obviously COVID, you have a vaccine. I think things should start to pick up, and you're going to start to see people go back to work. You're going to see people living there. But yeah, this is great stuff. I really thank you so much, Anthony. I really appreciate this. This is the first. Well, I was on your show before. Now this is the first time on our show, and we want to bring you on again, and talk more, because we know that you're in the trenches. You're doing deals. You see what's going on. And really, and I know, like, if I ever have a question, like, back and forth, well, I'll call you up, hey, Anthony, or you call me. That's the point of this business, is the relationships that you have. We really value the relationship we have with you. Thank you so much.
No, I really appreciate that. And yeah, you were one of my early guests on the podcast, so I'm happy to have you on again as well. Really appreciate it. So
everybody, this is it for our episode with Anthony and Red Knight Properties. Just this is a very good just view. There's a high level view of what's going on in the industry for workforce housing, multifamily. And we'll look forward to having you on again. Thank you so much.
Thanks, Adam.
Thank you, Anthony. Yeah.